Welcome, everyone. So, right at the heart of finance, there's this fascinating puzzle that spreadsheets and formulas just can't seem to solve. How is it that a janitor with no formal training can end up a multimillionaire while a Harvard-educated finance executive goes completely broke? Well, the answer, it turns out, has a lot less to do with math and a whole lot more to do with us, with human behavior. Okay, let's just dive right in with a tale of two very different people. First, you've got Ronald Reed. He was a janitor, a gas station attendant his whole life, but through incredible patience and steady investing, he quietly built up an $8 million fortune. Then you have Richard Fuscone, Harvard MBA, a top exec at Merrill Lynch. The guy had everything, except he borrowed way too much to fund a massive lifestyle and ended up bankrupt.
And this story just perfectly captures our big idea for today. Financial success isn't really a hard science, It's a soft skill. Your behavior, your patience, your discipline, that stuff is often way more important than what you know. We tend to teach finance like it's physics, with these clean, unbreakable laws, when in reality, it's so much closer to psychology.
So how does this actually work? Well, in this explainer, we're going to break it all down. We'll start with the traditional, rational way of looking at finance. Then, we'll introduce the human element. We'll see where these two worlds collide across 5 big debates. And finally, we'll see what it all means for you. First things first, let's do a quick refresher on the world of finance as it's been taught for decades. This is the foundation, the stuff from all the textbooks that has really shaped how we think about markets. At the very center of all this is the efficient market hypothesis, or EMH. And it's a really powerful idea. It basically says that at any given moment, a stock's price already reflects everything known about it, the good, the bad, the ugly. So what's the big takeaway? You can't consistently beat the market, because the market already knows what you know, and probably a whole lot more. Now, this whole theory is built on some pretty big assumptions about people. It assumes that we're all perfectly rational, that we're basically walking calculators always trying to get the most return for the least risk. It assumes that when we do make mistakes, they're just random blips that cancel each other out. And if a price ever gets out of whack, these rational traders called arbitrageurs will jump in and fix it instantly. It's a world of perfect economic logic.
But what if that's not the whole picture? What if we aren't always rational? This is where a whole different way of thinking comes into play. It doesn't totally throw out the old models, but it adds this crucial, very real layer of psychology on top.
And this is behavioral finance. It doesn't assume we're irrational or crazy. It just assumes we're normal, human. We have biases, we feel fear and greed, we use mental shortcuts to make decisions. This field studies finance from that very normal perspective. So this brings us to where the rubber really meets the road, how these two different views clash on the biggest questions in finance. This tension really comes to a head in 5 key debates that challenge everything we thought we knew about how markets work. Let's dig in.
Okay, first up, we have to ask about the investors themselves. Are we these cold, calculating economic robots from the textbooks? Or are we, a little more human?
Standard finance says we're just mean variance maximizers. All we care about is the highest return for the lowest risk, period. But behavioral finance says, hold on a second. We're subject to all sorts of cognitive errors, like being way too confident, and emotional ones, like panic selling. It also says we care about expressive benefits, what our investments say about who we are.
This chart makes the point perfectly. Look at this. Between early 2020 and late 2023, ExxonMobil blew away Microsoft and the S&P 500 in terms of returns. A purely rational machine? Easy choice. But for many of us, thinking about climate change, would we choose it? Maybe not. We might actually give up some of that return, that utilitarian benefit, for an expressive one, for feeling good about where our money is.
And that leads us right into our next big debate. If we're not just purely rational maximizers, then how do we actually go about building our investment portfolios?
So the standard theory says we should have one big master portfolio that's perfectly optimized. But behavioral finance suggests we actually think in mental buckets or layers. We might have a safety bucket at the bottom to protect us from disaster, a lifestyle bucket in the middle to maintain how we live, and then maybe a small aspirational bucket at the top for those high-risk shoot-for-the-moon bets. All right, let's talk about something that affects absolutely everyone, whether you're an investor or not. Saving and spending. How do we decide between enjoying our money today and putting it away for tomorrow?
The traditional life cycle theory makes it sound pretty simple, like it's just a math problem we can easily solve.
But behavioral finance points to a very, very common human trait. We have weak self-control. That desire for instant gratification, for the new phone or the vacation right now, often just steamrolls our long-term goals. It makes saving correctly incredibly hard.
And the data backs this up in a big way. In mid-2023, the U.S. personal saving rate was just 4.3%. I mean, let that sink in. For one of the richest countries in the world, that number is unbelievably low.
And what's really eye-opening is that this isn't just a low-income problem. A staggering 58% of all adults in the U.S. are living paycheck to paycheck. This points directly to a massive behavioral challenge with self-control, not just a lack of money.
Okay, so if investors aren't purely rational, and we all struggle with saving, what does that actually do to asset prices? What determines the returns we can expect to get?
You can really see the difference here. Standard finance has a clean formula. Your return is the risk-free rate plus a premium for taking on risk. Behavioral finance says, yep, that's part of it, but it adds two more things. An affect premium, which captures how we feel about a stock, and a factor for potential mispricing caused by all those feelings.
And all of this leads us to the final and probably the biggest question of them all. If investors are normal, if portfolios are built in buckets, and if our emotions affect returns, can markets really be efficient? Now, the behavioral view here is really subtle. It argues that, yeah, because of investor psychology and the fact that arbitrage isn't perfect, prices can definitely drift away from their true value. Think of bubbles and crashes. But, and this is so important, it agrees that markets are still incredibly hard to beat. Just because a market isn't perfectly rational doesn't mean it's easy to make a buck.
In fact, that force that's supposed to fix everything, arbitrage, has its limits. This quote is fascinating. It basically says that during the dot-com bubble, even pro-hedge fund managers who knew stocks were overvalued found it was a better strategy to just ride the wave up rather than fight it and risk looking stupid in the short term.
So, let's pull all of this together. After seeing how the behavioral view challenges all these traditional ideas, what are the big takeaways? What does this new lens really show us?
Here they are, the 5 core arguments we've just covered. And you can see how they create this logical chain. It all starts with the idea that people are normal, not perfectly rational. Because of that, we build our portfolios in these psychological layers. Because we're human, we struggle with self-control and our emotions impact returns. And when you add it all up, you get a market where prices can, and often do, stray from their fundamental value.
So, why does any of this matter to you and your career in finance? Why bother with psychology when you could be perfecting a valuation model? Well, the answer is pretty simple. Your models will always be used in a world full of humans.
Because in every single one of these roles you will ever play, as a planner, an allocator, an advisor, an investor for yourself, you're not going to be dealing with those theoretical, rational agents. You're going to be dealing with real, normal human beings. And understanding their biases, their fears, and their goals is every bit as important as understanding a balance sheet.
And that brings us to one final thought. As you move forward, as you build your complex models and analyze all the data, just don't forget the human element that drives it all. Knowing that behavior is just as important as knowledge, what are you going to look for beyond the numbers?